Our firm currently manages over 430 million in commercial real estate, but if I lost it all tomorrow, if I had zero cash in the bank and I had to start completely over from scratch, I wouldn't go looking for a bank loan, you guys. I would focus 100% of my energy on one specific acquisition strategy. And today, I'm going to show you exactly how it works, so let's get into it. If I had zero cash in my name, you guys, what I would do is I would go become an expert on finding the best possible deal I could, and then I would bring it to an operator and we would do the deal together. Because the reality in real estate is the value is in the deal. You know, when we're raising capital, I'm never selling anybody on why they should invest in the deal. I'm just showing them why we think this is an opportunity to help us grow our wealth tremendously. And either they see the opportunity or they don't. But the single biggest thing that can drive wealth quickly is if you can go find a stellar deal. Because if you can find a stellar deal and you bring it to an operator that has the ability and the experience to really drive net operating income, that's how you're going to create value for your investors. And the person who goes and gets the deal, they hold the gold. And if you're looking for a stellar deal, what I mean by a stellar deal is there is meat on the bone, or you've got it for a large discount below what it would cost to build it. So for us, when I'm looking at a stellar deal, I'm looking for a location, right? I'm looking in a sub-market that has the bandwidth, the job growth, the population growth that'll really help support our business plan. And then we're going to create a value add strategy that's ideally rinse and repeat. We've done it over and over again. And we can come in day one and start implementing our CapEx plan and very nicely, very smoothly, very consistently drive net operating income. Because I've said it before, and I'll say it again here, is $1 of NOI increase is $20 of value on the exit by a 5 cap. So if you can increase net operating income on a deal by $1 million over a 5-year period, and it's an A location or the B plus asset, and it's a 5 cap, you've just created $20 million in value. That's an example of a stellar deal. The most efficient way that we're finding to raise capital these days, you guys, is to just really be your word and have a track record that shows trust. You know, if someone can get to know you, or better yet, referred from another investor who's been with you, that builds incredible trust. You know, the biggest thing that we find investors are looking for is a place to protect their capital. Show me a place where I'm not going to lose my money, A, and B, now, how can you actually increase the value? What are you going to do? Show me a business plan that's real, based off of data that we can see and I can understand, and explain it to me in layman's terms of this is exactly how we're going to do it, how we've done it, this is how we're going to do it here, that the investor can now see the opportunity and believes in the opportunity. Because once the investor believes in the growth of the NOI, believes in the ability of the operator to force value, now they're going to get excited, and now they're going to want to come with you. Now they're going to be a great partner of yours, which, you know, in this case is a limited partner or a passive investor. And so really it's about building trust by being very consistent, being your word, showing up, doing great work, getting referrals, getting your investors to say, hey, yeah, I invested with the Granite Towers Group. And, you know, I've been through 3 deals and they've been phenomenal. And even for the deals that didn't perform, they showed up. They were exactly their word. They showed up on the first of every month, giving us an update. You know, on the first of every month at 7 a.m., you're getting an update from us. You're going to hear the good, bad, ugly. Like, I mean, if there's challenges, which there will be, I mean, this is real estate. Like, you're not going to have everything just go perfectly. So when there's challenges that show up, how do you address those challenges? How do you help your investors understand what you're doing to get ahead of those challenges? That's the stuff that really drives trust and builds belief in you as the operator. The reason the deal is always more important than the money is because that's what you're owning. You know, that's what is going to be the vehicle to drive net operating income. Now, I will say, you got a great deal, but a poor operator, you're still in a tough spot. So there is a combination here. You want to have a great deal, but you need to have a great operator. You give someone a great deal and they're a poor operator, they're going to have poor performance. You give someone a pretty tough deal and you give them a great operator, you're probably going to have still pretty good results. So above the deal is definitely the operator. There's no question about that. You first got to be betting on the right jockey. The horse, the deal, that comes down to what you actually can do. And that's going to be the story, right? I mean, right now, if you're buying assets in this market, you're likely seeing 20, 30, or even 40% discounts from where things were in 2021. And so the question is, well, are we still going to keep dropping? Are we still going down? And from what we can see with the data, focusing on the actual data, we can see that interest rates have gone up a little bit, but they're not in a position right now where they were doing like they were with the Fed with inflation ripping. And the biggest thing that's changed is this huge glut of supply that was started when rates were zero back during COVID. That all is getting absorbed and there's not much to come behind it. So based off of the fundamentals, based off of the data, where are we buying? Is there population growth? Is there job growth? How many new units are coming online? All of that will help you be able to project and predict what your rent growth will be, what you're actually able to do with that asset. But the biggest thing, far and away, the deal's got to be good, but the operator's the most important part. If you're sitting there making good money, whether that's W-2, business income, whatever, and you feel like you should be further ahead than you are, it's probably not an income problem. It's a structure problem. I put together a free blueprint that breaks down exactly what I mean by that, and it covers the 3 tax buckets, why most real estate actually fails as a tax strategy, and the capital framework I personally use to evaluate where money should go as income grows, and it's completely free. Links down below. I think a lot of times people just get really excited about buying and owning a piece of real estate, and they don't take enough time to really get educated on what they're doing. And that initial excitement, FOMO of getting in, is something that any investor, any astute investor has to be in control of. You have to be aware of it, right? You have to be cognizant of how much excitement you have when you're buying, because the reality is once you close, that asset is yours. All of it, the good, bad, the ugly, all of it is yours. So before you get super excited and go run and jump into that Airbnb or whatever asset class you're looking at, I first can't stress enough how important it is to find a mentor. Find somebody who's been doing it. Make dang sure that they double check your work. Give you feedback on, hey, here's the things you're going to want to watch out for. Because mark my words, for somebody who's been doing this a decade or 2 decades, they've been through the good and the bad. And they have a perspective that's invaluable to have and to hold in your mind's eye before you go and purchase that first piece of real estate. But once you've made, that effort, once you've had that training, once you can see an opportunity in your mind's eye, now it is time to act. So just make sure you don't mix those up. I can't stress enough how important and powerful mentors are. When I was in my snowboarding career on my way up, before I was a professional snowboarder, my mentors were guys that I could watch on film. And I couldn't associate with them, right? They lived out in the mountains in Colorado and Utah and Europe and all that. And all I could do was watch them on tape growing up in Minnesota. So I would spend my summers watching snowboarding film all the time. Like I obsessively watched snowboarding videos until the point where the VHS tape would literally burn out. I mean, it would stop working because I watched it over and over and over and over again. And while watching, what's happening is my brain was being trained. And I didn't know this at the time, but I'm literally training my brain on how to learn tricks by watching it over and over again in slow motion, frame by frame by frame, until it gets to a point where I can see the trick clearly in my mind's eye. And I would show up at the jump the first time of the year, and I would drop in and I would do this trick that I've never done before in my life. I'd get to a jump and I would tell my buddies I'm going to try this trick, and they'd all be like, oh, okay, good luck. And boom, you'd hit it first try perfectly. Like I'd done it hundreds of times, and they'd all show up and be like, how did you do that? You've never done that trick before. And the only answer I had was I watched it on videotape so much. I watched my mentor do it so much that I could feel it and I could see it clearly in my mind's eye and I could go do it. Same with investing in real estate. Heck, same with anything in the world. Whatever you really, really, really want, go find somebody who's already doing it. Verify that they're doing it, right? You got to make dang sure that they're not smoke and mirrors. Verify that they're doing it successfully and have done it over and over and over again. And then how can you associate with those folks? How can you bring value to those folks? Maybe it's working for free. Maybe you're going to give them some money for training. So my most superpower move to moving at a pace that's faster than most is before I go and start to do it and figure out how, I find somebody focus on the who first. Who can help me learn this? Who can I stand on the shoulders of giants, learn from these folks, take their experiences, their mistakes, their positives, put it all together, and now go and do. And so I cannot stress that enough, you guys. Who, not how. Don't go figure out the how right out of the gate. First, figure out who and how can I associate with those people. So there's your how. How do I associate with these people? Not how do I go do the act. For me, a real business is one that cash flows and can run without me. That's a real business for me. And when we're looking at real estate, that's our underlying principle. The underlying buying foundation is how much cash flow do we have at the end of the month, at the end of the quarter, at the end of the year, compared to how much we're investing in the deal. So that measurement is simply called cash on cash return, and it's measured in a percentage, right? So if you can get 7% cash on cash, 8, 9, or even 10, all that 10% number means is if I put $1 million in, I get $100,000 a year of cash flow, right? And if you're getting into those double-digit cash flow numbers and you can find appreciation and depreciation, you're killing it. So right now, if you can even get to 7 or 8% cash flow, really, really strong. And keep in mind, you guys, the newer, nicer, more certain of the asset, the lower the cash flow projections. If you see a deal that says I got 10, 12, 15% cash on cash, there has to be risk there. Otherwise, that general partner wouldn't be giving that much away of the deal. They would take more of the deal, if that makes sense. So just because there's higher returns, just because it's higher cash flow, does not mean you're going to get better returns. It's a rookie mistake right there. I had 2 deals I was looking at. One provided a 4% cash flow. The other one provided 6% cash flow. I went with the 6%. One provided 5, one provided 10. I went with the 10%. Well, the reality is who's the operator? What's the market? Is the 10% cash flow legit, or is it just 10% on paper? Because anybody can put anything they want on paper and make you think that this is a really great deal. And that's another point I just bring up while we're talking here, you guys, is that when you look at multiple deals to invest in as a passive investor, do not just go invest in the one with the highest returns. In fact, you may want to raise your eyebrows. And I've gotten sucked into this, done this, unfortunately. Looking at many different deals, I'm looking at a deal that's outside of my wheelhouse, right? That's a red flag. I'm just telling you guys a mistake I made. I invested into a cannabis company, right? And thinking, oh man, I'm going to have these huge returns. Well, when you see 0 returns from your capital invested, it's a hard lesson learned. Don't make that mistake. Just because they market very, very high returns does not mean you will see your capital come back. And if you do see very, very high returns, be cautious. It should raise a red flag immediately, because anybody who's raising consistently and has a great deal, they're not going to have to put those types of returns out there. The capital chases the more conservative returns because those folks have a track record and they've done it over and over again, and there's capital lined up ready to go. If you can't raise capital, you might show 150, 200% returns in 5 years. Completely red flags. Yeah, if you're listening to this and you have $0 and no experience, the first question is why do you have $0? I mean, if you're 18, 19, 20, maybe that's, a reason, but still, even at 18, 19, 20, you should have some capital. So I'd take a really good hard look at your habits of when you make money. When the money comes in the door, do you immediately spend it? Do you froth at the idea of spending, or do you get excited about saving? And either one of those is a habit. And you either have a spending habit or a saving habit. It's really simple stuff. So if you keep having income come in, and as soon as you get it, you're immediately buying, you need to be aware of that. And it's going to be very difficult for someone who immediately spends to really get ahead. Whereas if you have the habit and excitement of saving, I just saved $5,000, another $10,000, here's another $5,000. And as you're doing that, you're educating yourself. Now you're on a rocket ship to get ahead. Now you're on a platform that really can help you change your lifestyle. That's something that parents that are listening, what I love to do with my kids is 20, 50, 80% of what they make immediately gets carved off and saved. And I mean, really, what do my kids really need when they're 12, 13 years old, or even, 8, 9, or 10? Not that much. I'm providing 99% of it anyways as their dad. But when they get paid, most of it goes into a savings account. And I help connect that with a feeling of positivity. You're going to put that capital over here someday, and it's going to make you more and more capital. And as long as you create that habit, you can create anything. So once you have that down, you've got the saving habit in place. The second part is get educated, and get educated on something you're interested in. One of the guys I listen to a lot, Robert Kiyosaki, he says, start putting money, just a little bit, in different assets. That will help you pay attention more. So if you're starting out, you're not sure, do you want to be real estate, crypto, stocks, whatever it may be, start putting a little bit of capital in all of them and see what one grabs your interest, and be educating yourself on these different asset classes. For me, obviously, is real estate, because my holy grail is cash flow. If I can find cash flow in other assets, I'm interested in that asset, because I'm looking for capital right now. How do I turn my money from this month, from an ordinary earned income, to next month into passive income that I start to see real time? It's that game. How quickly and efficiently can I turn my ordinary earned income into streams of passive income? Because that's the income I'm looking for. That's the goal. That's the holy grail for me, is cash flow. Yeah, if I'm a high income earner, number one, I'm just doing a self-assessment of how involved do I want to be with the real estate? Do I want to be literally a part of due diligence? Am I going to put a large chunk of capital in this deal where I need to be intimately involved? That's one level. If it's, hey, I got 100 or 200 or 300 grand and I'm just looking to be a passive investor, that's a very different play. So if I'm a high net worth, high income earner, I'm doing a self-assessment of how much time and interest do I have in the real estate I'm looking at buying. And that's going to dictate and separate how much effort I'm going to be putting in on a day-to-day basis. And that's really the underlying key right there, is how involved do I want to be versus how passive do I want to be. And now you know your lane. You're either going to go out and be a general partner, you're going to source the deal, create the capital, create the business plan, you're going to run the deal, or you partner with us, you're going to come along as a passive investor. We're going to go do all that for you. You look and assess, do you like the deal or not? Yep, I like it. Boom, you invest. Now you're along for the ride, getting monthly updates, enjoying that passive role. The market doesn't care about your exit strategy if you don't know how to acquire the deal in the first place. If you want to see exactly how we are acquiring off-market commercial real estate deals right now and how you can passively invest right alongside us, click the link below to get in touch with our team, and I'll see you on the next one.